Welcome to this ACCA MA explainer. If you're gearing up for your management accounting exam, time is absolutely your most precious resource. So we are skipping all the fluff today. We're going to laser focus on two massive areas of the syllabus that constantly trip students up: throughput accounting and budgeting. We're stripping away the complexity and giving you the exact no-nonsense frameworks you need. Let's jump right in.
Here's a quick look at our roadmap for today. First up, an intro to throughput accounting. Second, calculating the TPAR. Third, we'll hit budget types and traps. And finally, the budget sequence.
All right, let's get into Section 1, Intro to Throughput Accounting. So let's define throughput. At its core, it's just sales revenue minus direct material cost. Now, you might be wondering, why is this so radical? Well, traditional accounting tries to tell us that labor is a variable cost. But think about a modern factory. You don't just send your workers home the exact second a machine breaks down, right? Throughput accounting operates on the assumption that direct material is the absolute only truly variable cost. Everything else, it's fixed. The core philosophy you need to internalize is this: throughput equals sales less material, and you must maximize it per bottleneck. Your ultimate goal on the exam is to maximize the return on whatever resource is holding your production back. Like, if your testing machine can only handle 10 units an hour, you have to prioritize the products that generate the absolute most throughput cash for every single hour spent on that specific machine. Moving right along to Section 2, calculating the TPAR. To calculate the throughput accounting ratio, or TPAR, you're going to follow 3 strict steps, and they have to be in order. First, find your throughput per unit, which is just selling price minus direct material cost. Step 2, you take that number and divide it by the hours used on the bottleneck. That gives you throughput per bottleneck hour. Finally, divide that hourly throughput by your total factory cost per bottleneck hour. And all that math, it leads to one golden rule for the TPAR: greater than 1. If your TPAR is greater than 1, the product is generating more throughput than the factory costs to run. That means it's profitable. Make it. But if it's less than 1, you are literally losing money on every hour spent making it. So you drop it. It's really that black and white when you're sitting in the exam room. All right, let's switch gears a bit. Section 3, Budget Types and Traps. Let's just ground ourselves with the absolute basics first. What is a budget? It's simply a quantitative plan for a future period. It's your company's financial blueprint. But here's the thing. The examiner isn't just going to ask you what it is. They will test you heavily on the different types of budgets and exactly how they operate within a company's hierarchy. So let's contrast a couple of distinct approaches. A top-down, or imposed budget, is dictated straight from the boardroom. Senior management sets the targets and aggressively pushes them down the chain. It's fast, sure, but it can seriously demotivate your staff. On the flip side, we've got the bottom-up, or participative budget. This allows department managers to prepare their own numbers. It's great for morale, but watch out, because those managers might secretly build in budgetary slack just to make their targets easier to hit. There's also a massive distinction between fixed and flexible budgets. Fixed budgets are static. They're set at the beginning of the year, and they are totally rigid. They're traditional, but frankly, often useless for control. Flexible budgets, however, mathematically adjust to your actual volume. Think about it. If you plan to make 10,000 units, but you actually made 12,000, the flexible budget recalculates your expected cost for those 12,000 units, so you can actually compare apples to apples. Next up, we face the ultimate efficiency test. Incremental budgeting is, well, kind of lazy. It's taking last year's figures and just slapping on a percentage increase for inflation. The problem? It just perpetuates past inefficiencies. Contrast that with zero-based budgeting. Here, every single cycle starts from a completely blank sheet. You must justify every item from zero. It absolutely cuts the fat, but as you can imagine, it's incredibly time-consuming to actually implement. Okay, listen closely, because you do not want to fall for this classic exam trap. The examiner loves to give you a scenario where a manager budgeted for one activity level but achieved a totally different one, and then they'll ask which budget you should use to evaluate them. If the volume has changed, the answer is always, absolutely always, the flexible budget. You just cannot mathematically or fairly compare actual costs for 12,000 units against a fixed, rigid budget for 10,000. It doesn't make sense. On to our final stretch, Section 4, the budget sequence. You absolutely have to memorize this rigid 7-step order. Everything starts with the sales budget. I mean, you can't plan production until you know what you can actually sell, right? Next is your production budget, which you adjust for inventory. That production number dictates your material usage budget. Adjust that for material inventory, and boom, you get material purchases. Then comes the labor budget, the overhead budget, and finally, aggregating all of those flows together, the cash budget.
Here is another trap where students just throw away easy marks. When the examiner hands you a question that's absolutely filled with production volumes and raw material inventory data, they are testing a very specific formula. They want to see if you know that material purchases equal material usage plus closing inventory minus opening inventory. If you just multiply production by material per unit, you've only calculated usage, not purchases.
So your mental summary to remember this whole flow is actually really simple. Sales dictate production, production dictates materials, materials dictate purchases, and the whole thing ends in cash. If you can internalize that logic, you can reason your way through almost any sequence question on exam day. And as we just said, the whole sequence culminates in the cash budget. This is a predicted schedule showing your expected cash inflows, your cash outflows, and your closing bank balance. Notice the language there, strictly cash flow. It has absolutely nothing to do with accounting profit or depreciation or accruals. Honestly, if physical cash isn't moving, it does not belong anywhere near this budget. Which brings us to our final exam trick for today. Timing is literally everything on a cash budget question. If you make a credit sale in January, but the payment pattern dictates they pay in February, you only record that cash inflow in the February column. The month of receipt is the only thing that matters, regardless of when the sale was actually recorded in the books. Do not rush those timing patterns. As we wrap up this explainer, I want to leave you with kind of a provocative thought. If throughput accounting tells us the real world revolves around shifting, unpredictable bottlenecks, is the rigid, traditional fixed budget already obsolete? It's a huge debate happening in boardrooms right now. If you can master that intersection between the messy reality of the factory floor and the strict planning of the boardroom, you are going to absolutely crush these topics on your exam. Keep setting smart, and we'll see you next time.